Those of you who don't know me, I'm Luke Gromen, founder and president of FFTT, Forest for the Trees, a macro thematic investment research firm, and jumping on here to talk about a couple of things that have grabbed my attention recently. The first has been, I think we're going to start to see a test in real time this week, perhaps. Maybe we started to see it on Friday, of what we've called the U.S.'s trilemma, which is to say that ever since global central banks stopped stockpiling treasury bonds back in the third quarter of 14, or about 4 years ago, the U.S. has become subject to what we've called the trilemma, which means the U.S. can have only two of the following three. Number one, they can have stable to rising dollar, rising rates, and rising equity markets. And obviously in 2017 we had a falling dollar, rising rates, rising equities. That continued into this year for a little bit, and ever since then we have had rising rates, rising dollar, and chopping equities. And now, like I said, I think we're going to start to see some real-time test of this thesis in markets. So that's number one on the trilemma. Number two thing that grabbed my attention recently, I don't know fully how to position for this from an investment standpoint. It's something we've started to see here in what we fondly refer to as flyover country. But where I'm sitting right now is probably about 50 miles as the crow flies from the Pro Football Hall of Fame, and have now heard in the last this season and last season at least three big public schools around the Cleveland area that have not had enough numbers to field freshman football teams, with the obviously a millennial generation that's the biggest in U.S. history. And so it's an interesting potential shift. Like I said, I don't know how to play it yet in markets, but just the standpoint that there seems to be a bit of a shift at a grassroots level in terms of the popularity of football amongst the millennial generation in what is arguably the cradle or birthplace of football. And so with that, I am going to open things up for questions. If you have a question, please feel free to jump on and ask, and I'll do the best I can and stay on here to ask a few questions. You can see here this week, last week we had a Cleveland St. Ignatius shirt on. This week we've got our beloved Cleveland Indians. So go Tribe. We're hoping that maybe we can do okay against the Yankees, or at least better against the Yankees this year in the playoffs. Let me know if you have any questions out there. I think I've enabled the comment section. There we go. Okay, we're starting to get some comments and feedback now. Comments on Turkey. Comments on Turkey from Tom. It is, to me, a number of things that grab my attention. Obviously, it's been surprising how quickly it's developed. Number two, it is, as far as I know, the first time the United States has contributed to a currency crisis in a member of NATO. Perhaps since Ike threatened the pound during the Suez Crisis in the mid-1950s, as somebody pointed out to me last week, which I thought was a very valuable insight. Ultimately, the big thing I'm watching for is contagion. Do they owe European banks money? Who do they owe money? What currency do they owe that money in? And then we'll watch it spread from there. It could very well possibly be a contagion. You're welcome on the Macro Voices appearance. Always happy to join them. Those guys do a great job. Eric and Patrick, in fact, was just up in Toronto at the inaugural Macro Voices Live conference. It was a very enjoyable event. A lot of people up there. Great to meet everybody that I did get to meet. If you're jumping on, really enjoyed spending time both with everyone I met there as well as the other presenters who had some really interesting presentations. Jeff Snyder on the Eurodollar system, Josh Steiner from Hedgeye on the Canadian banking system, Kevin Muir talking about a number of different macro issues, and then Eric and Patrick themselves also made great presentations. Let's see. Gold pegged to the yuan, long-term bullish. Gold pegged to the yuan. You know, it's one of these things where initially when I saw the correlation, it was very difficult, correlation, causation, etc. The longer it goes on, the more it looks like it is a effective peg, which is I'm a little it makes me uncomfortable to say. We'll see how it continues to develop, but I ultimately continue to think that what China's doing with gold is a very elegant setup and solution. Let's see what other questions we have here. Do I like gold here? I continue to think gold in this cycle will be CDS-like returns. I continue to think that it's, it looks like a lot of the technicals are extremely stretched, commitments of traders, reports, etc. Ultimately, I am not the best source for that. I would turn your attention to others for that information. They do a better job, and I certainly pay attention to some of their work. I know, David Brady on Twitter, Global Pro Trader, is somebody I follow that watches that much more closely than I do, and I've been noticing his comments and others that those commitment to traders reports are quite stretched. I've not been paying attention. What's my take on what is going on in northwest China where the native peoples are being rounded up? Have not seen that. I appreciate the heads up. I will take a look at that and see what that is. Not in a position to comment at this point. Dollar versus gold, week, month, quarter view. We just talked a bit about that in terms of some of the commitment of traders being stretched in the nearer term views. Those are things I would pay attention to for a look on that. Stretched to the negative, I should say. People very bearish on gold, and some that has been an indicative of some snapback returns recently. CDS-like returns. What do I mean when I say CDS-like returns? What I mean by that is, if you remember back in the crisis in 07, 08, CDS are credit default swaps. So it's a reference to subprime credit default swaps, which were effectively insurance policies written by the big banks against subprime mortgage bonds. Basically, they were a leveraged bet that home prices would not fall, that subprime mortgage bonds would not default. When they began defaulting, initially the subprime CDS prices didn't move, or in fact fell when they should have been rising tremendously. And then ultimately, once the big banks were on sides vis-a-vis the credit default swap positions, or hedged out of them, then credit default swaps were allowed to be marked to market in appropriate fashion. They ultimately ended up returning in some hundreds, in some cases thousands of percents, and that's what I think. That's what ultimately, over the course of this cycle, gold is the asset class most likely to see CDS-like returns. That's what I mean when I say that. The question, of course, is how long does a sovereign debt cycle continue to play out? With Europe getting more complicated, do you see a shift away from yuan-gold correlation? I don't know. I think we're going to have to watch and see. I don't have a very strong feeling on that. I apologize. U.S. dollar going to scream higher, way higher, as some are forecasting. It's possible. It is very possible. As we noted, the first thing we talked about is this trilemma, which is dollar higher, rates higher, stocks higher. Fed and U.S. can only have two of those three. And so the issue, as we've noted, going as far back as over a year now, the dollar could absolutely scream higher, way higher. Yes, it is going to break a lot of things on the way up, and including, in our view, U.S. equity markets, corporate profits, etc. What is my view of Lacey Hunt's secular low in Treasury yields is still ahead thesis? I will lead off by saying that I think Lacey Hunt is absolutely brilliant, and I think his work is always insightful, and read it in his quarterly updates as frequently as I can. I think Lacey Hunt could very well be correct that the secular low in U.S. Treasury yields is still ahead of us. My question is less what do yields do, and more what does the S&P 500 over, sorry, bugs are starting to come out, S&P 500 over the TLT do. In other words, a key metric of what we're watching develop in markets is the S&P 500 or SPX over TLT, which is an ETF of the U.S. long bond. Ultimately, it is very possible U.S. Treasury yields could be much lower. For them to get there, we think it's going to need intervention by one or more central banks, possibly the Fed and others. In other words, we think the way this cycle ends in terms of, it could be that the Fed pins yields at a new secular low in Treasury yields, as Mr. Hunt notes. But in that case, stocks are going to go much, much higher. And as such, that SPX over TLT ratio would go significantly higher. Do I expect a global reset? Look, I think we're in the midst of a global shift in the global currency system. I think it's probably 20 years in. We mark really the acceleration or quickening of that change or restructuring of the global currency system to the launch of the euro. And so I think we're seeing a further quickening of that with what China's doing. To me, maybe one of the best metrics of where if that restructuring is quickening or slowing is global geopolitical tensions. To the extent they heighten or increase, to us that's a sign that they are getting that the restructuring is progressing faster. Are we Japan 2.0? No, not in my opinion. Two reasons. Number one, Japan runs a significant current account surplus. Number two, Japan has significant offshore assets, as somebody pointed out to me over this weekend at the Macro Voices conference, which I think is a very excellent point. And number three, and I know I only gave you two reasons, but number three is the United States provides defense, Japan's defense for it in a large part, and so that is an element of Japan's budget that they have not had to spend at the same rate that the United States does, and so there's a number of differences there. Comments on the most recent events of the dollar shortage. It looks like it is getting much more acute in recent days and weeks. And like I said, within this trilemma, I think as we saw, as we've seen the Turkish currency go above 7 tonight, or 7.2, I think I saw before checking on tonight. I think we may see things accelerate further this week. So let's watch that. Who has the best cards right now? From Doug Green, U.S. or China? I think it depends on how you're looking. I think tactically I think in the near term the United States is a very big bat, and I think it can swing that bat with a whole lot of force, and it appears to be doing so. That will be a very powerful card to play right up until the moment it's not. Ultimately, we had a tweet earlier today noting that, it looks like the U.S. is trying, basically trying to threaten countries that are de-dollarizing commodity markets by sanctioning them, which will force them to de-dollarize faster, which doesn't seem like an optimal solution or outcome. Ultimately, when you look at the big picture, I think U.S. still has the best cards if we can play them right, if we have the political will to play them right. What I mean by that is you still have, for the U.S., you still have the university system, well-established history of property rights, intellectual property rights, a nation that is in significant need of infrastructure refreshment or refresh of our infrastructure, which means we have a lot of domestic demand we could create with the right political motivation. We need the political motivation, though. My take on Russia selling almost all of its treasuries. I ultimately think that you look at Russia as an oil exporter. They're buying gold and selling treasuries, and I think some of this is purely tactical from the standpoint of selling treasuries. Sorry about that, camera flipped on me. Selling treasuries to preemptively get ahead of any additional U.S. sanctions. But I also ultimately think, too, that they're telling you that they want to do their part to move the system to a neutral settlement asset away from the U.S. Treasury as the global settlement asset and primary reserve asset. And so I think that is what they are really trying to do here. I will take a look at this FT article after. Unfortunately, I can't see what it is. Let's see what else we got here. Can you talk about the role of the repo market in providing liquidity, particularly PBOC's open market operations? It's a good question. It is an important question. It is one that at this point I'm not comfortable talking about. I simply haven't read up enough on it, as it does seem like there's some perhaps some incremental liquidity being provided on that, but in terms of the mechanisms and sort of where else that may or may not show up in global markets, I just have not dug in deep enough to be able to offer anything value added there. So I will pass on that to a future moment. Let's see. If no reset, how to develop the economy, service a debt load that seems unserviceable. Ultimately, they have to repress holders of sovereign debt. I would highlight that in the last time the world had a global sovereign debt bubble, which was in the 20s and 30s, you had the sovereign debt of basically every major Western power fall between 60 and 100% on a real basis. In other words, U.S. was probably the least at a 60% devaluation of the currency, and 33, of course. Russian sovereign debt went to zero. Japanese sovereign debt fell tremendously. German sovereign debt went to zero, of course, with the famous hyperinflation. French sovereign debt was devalued significantly, as was British sovereign debt. So ultimately, I'm not making the case, to be clear, I'm not making the case that sovereign debt is going to fall by 60 to 100%. Our case that by the end game to this cycle is the only way to make this debt, the sovereign debt, sustainable is to reduce its value on a real basis. You are welcome. I'm glad, Pete, you're enjoying the format. What's the correlation you see between gold paper and physical as China and Russia keep buying? Correlation see between gold. To me, what seems to be happening is a new version of the London gold pool from back in the late 60s, early 70s, where the price of gold was $35 an ounce, and they moved it up to 42. But at any rate, price of gold was relatively fixed. Physical was moving to U.S. creditors. The price of gold was not. Something similar is happening. It's being managed in futures markets and paper markets, and that's why we continue to say it's not a real market. The price of paper is not being reflected in what's happening to physical, and we continue to think that'll be the case until suddenly it isn't. And obviously, as you saw the last time in the London gold pool, that was decided unilaterally by the United States by a politician in a small room with a couple of other politicians, and it was a binary decision over a weekend. And so I think very possible that history could rhyme in that fashion, the same way that history's rhyming vis-a-vis the London gold pool again. Let's see here. Can China intervention stop what appears to be an inevitable recession and debt crisis? Yeah, maybe. To me, the trick question, I guess, is if China has a debt crisis, what's the list of stocks in the United States I want to own? And that list is, it's pretty short. It might be no stocks, and that, of course, would be a problem for the United States economy as well. We've done a lot of work on how important stocks are to the economy. They're a leading indicator, not a lagging indicator. They are a leading indicator of U.S. tax receipts, etc. So, and that's one of these points we've made with this trilemma, where I think it's going to be important to really watch as things continue to increase. Let's see. The China-Ecuador article I retweeted, or I tweeted in response to somebody today. That's a 5-year-old article, actually. China had a monopoly on Ecuadorian oil 5 years ago, which is fascinating. It was, if you're paying close attention, you could see what the game is, where that was where they were really starting to cease buying U.S. Treasury bonds and instead go straight to the source, take their dollar surpluses and lock up supplies of physical commodities for years ahead of time. Continue to think that that's what they're doing, and continue to think that's what they will do. A couple more questions here, and then I got to jump off. Let's see. If I had to pick a short, what would it be looking at 6 to 12 months? I'm going to pass on that one for now. We don't do individual securities recommendations in terms of currencies and stuff. I'm going to hold off at this point. What would you accomplish by revaluing gold? Yes, so you would accomplish that by revaluing gold. Yeah, if you look around, if you have to devalue sovereign debt on a real basis, if you assume that central banks are going to continue to be the global financial power, run the system, there's only one asset on global central banks. Most global central banks' balance sheets, the Swiss National Bank certainly has a lot of U.S. equities, but most global central banks only have one asset to revalue higher that would then devalue the sovereign debt on their books, and that's gold. Do you think gold has become geopolitically insensitive as the dollar dominates? I think it's actually in the reverse. I think gold has become geopolitically insensitive because somebody wants it to be geopolitically insensitive. Any comments on Elon and funding secured? No. I admire Elon and what he is doing. I also understand this is a hot button issue. I will say I test drove a Model S one time. They put it in what was called ludicrous mode, and it's the most fun I ever had in a car. All right, everybody.